For decades, home ownership in the United States was seen as the safest financial decision a family could make. Buy a home, pay the mortgage, build equity. Simple. But in 2026, that idea is quietly breaking down. Today, owning a home is no longer just about the monthly mortgage payment. It's about a growing list of hidden costs that many homeowners never fully planned for. Property taxes that rise even when incomes don't. Insurance premiums that can double without warning, HOA fees, maintenance, and long-term risks that don't show up on a loan estimate. In this video, we're breaking down the real, often overlooked cost of home ownership in the United States, not to scare you, but to show you what owning a home actually costs in 2026. Because for many Americans, the biggest financial mistake isn't renting too long. It's buying without understanding the full price of ownership. Most Americans believe that if they can afford the mortgage, they can afford the home. That assumption is no longer accurate. In 2026, the mortgage payment is often just the starting point, not the total cost. When buyers shop for a home, they focus on interest rates, loan terms, and monthly payments. But many of the most expensive parts of ownership don't come from the lender. Property taxes, insurance, HOA fees, and maintenance are not fixed. They rise over time, often faster than wages or retirement income. This creates a dangerous gap between what a home costs on paper and what it costs to live in long term. A mortgage payment might stay stable for 30 years, but the true cost of owning that home rarely does. In fact, many homeowners don't feel financial pressure at the time of purchase. They feel it years later when taxes rise, insurance renews, and repairs become unavoidable. That's why, in today's housing market, affordability isn't just about qualifying for a loan. It's about whether you can absorb costs that keep increasing long after the keys are handed over. After the mortgage, the next major cost most homeowners underestimate is property tax. Unlike a mortgage payment, property taxes don't stay the same. They rise quietly, year after year. In many parts of the United States, property taxes increase even when home values flatten or decline. Local governments rely heavily on property taxes to fund schools, infrastructure, and public services. For homeowners, this creates a cost that feels more like rent than ownership. You never pay it off, and you have little control over how fast it grows. This is especially challenging for retirees and fixed-income households. When income stays flat, but taxes rise, the home becomes harder to afford each year. Many homeowners assume they'll be protected once their mortgage is paid off, but property taxes continue long after the loan ends. In some states and cities, property taxes now exceed monthly mortgage payments on older loans. This is one of the main reasons people leave homes they technically own outright. And in 2026, property tax pressure isn't a one-time shock. It's a slow financial drain that pushes households to reconsider where they live. Another cost that has quietly reshaped home ownership in the United States is insurance. For many homeowners, insurance is no longer a predictable expense. In 2026, home insurance premiums are rising faster than inflation in large parts of the country. Wildfire risk, flood exposure, storms, and rebuilding costs are pushing premiums higher. In some regions, insurance costs have doubled or even tripled within a few years. For homeowners in coastal states, flood insurance is often no longer optional. And in wildfire-prone areas, coverage options are shrinking while prices rise. What makes this especially dangerous is that insurance is required to maintain a mortgage. If coverage becomes unavailable or unaffordable, homeowners are left with few options. Some are forced to switch to weaker policies with higher deductibles. Others are pushed into last resort insurance programs that cost far more For fixed-income households, this turns a stable housing cost into an unpredictable financial risk. In 2026, insurance isn't just protecting homes. It's deciding who can afford to keep them. Another hidden cost many buyers underestimate is the Homeowners Association, or HOA. HOA fees are often sold as a convenience. Landscaping, maintenance, shared amenities. But in 2026, HOA fees have become a growing financial burden. Unlike a mortgage, HOA fees are not locked in. They can rise at any time, and often do. Insurance increases, repair costs, legal fees, and aging infrastructure are passed directly to residents. Special assessments are where homeowners feel the shock. A roof replacement, structural repair, or safety upgrade can trigger one-time bills running into the thousands. These costs are not optional. Failing to pay HOA fees can lead to penalties, liens, or even foreclosure, even if your mortgage is current. For condo owners and retirees, this risk is especially high. Fixed incomes don't adjust when HOA boards vote to raise dues. In 2026, many homeowners are discovering that maintenance-free living often comes with unpredictable and rising costs. And for some, HOA fees quietly become the deciding factor in whether staying makes financial sense. Beyond taxes, insurance, and HOA fees, homeownership comes with one unavoidable reality: maintenance. Homes age, and aging is expensive. Roofs wear out, HVAC systems fail. Plumbing, electrical work, and foundations don't fix themselves. In 2026, repair costs are significantly higher than they were just a few years ago. Labor shortages and material costs have pushed even routine repairs into the thousands. Many homeowners budget for monthly payments, but not for five-figure surprises. A roof replacement can cost tens of thousands of dollars. A major HVAC failure can hit at the worst possible time. These costs don't arrive gradually. They arrive all at once. For retirees and long-term owners, this creates financial stress even when the home is technically paid off. In 2026, maintenance isn't a minor expense. It's one of the largest and most underestimated costs of owning a home. One of the most overlooked risks of home ownership is liquidity. A home may be valuable, but it is not liquid. You can't easily access your equity when costs rise. And selling isn't always as simple as people assume. In 2026, many homeowners discover this too late. Rising taxes, insurance, and repairs create pressure. But the home itself can't quickly solve the problem. Selling takes time. Markets slow. Prices fluctuate. In some cases, homeowners face a difficult choice: sell during a weaker market, or keep paying costs they can no longer comfortably afford. This is especially dangerous for retirees. Equity looks strong on paper, but cash flow determines day-to-day stability. A paid-off home does not guarantee financial freedom. It can still demand thousands of dollars every year. In 2026, many Americans are learning that owning a home can lock you in, just as easily as it can build wealth. Despite rising costs, home ownership still makes sense for some Americans. But the conditions matter more than ever. Home ownership works best for households with stable income, long-time horizons, and predictable expenses. Those who plan to stay in one place for many years are better positioned to absorb rising costs. It also works better in regions with lower insurance risk, moderate property taxes, and steady local economies. Buyers who maintain emergency savings and plan for maintenance tend to experience fewer financial shocks. In these situations, a home can still provide stability, forced savings, and long-term equity. But the key difference in 2026 is awareness. Successful homeowners understand that owning a home is a long-term financial commitment, not just a monthly payment. They budget for rising taxes, higher insurance, repairs and uncertainty. Homeownership no longer rewards optimism. It rewards preparation. For those who understand the full cost, owning a home can still make sense. For those who don't, the risks are far higher than they appear at purchase. In 2026, the biggest shift in US homeownership isn't about prices alone. It's about total cost. Mortgage rates may rise or fall. Home values may go up or down. But the costs surrounding ownership are becoming harder to control. Property taxes rarely move in one direction. Insurance is increasingly tied to risk, not affordability. HOA fees and maintenance costs continue to rise with age and inflation. For many Americans, this turns homeownership into a long-term financial commitment that requires constant cash flow. The mistake in 2026 isn't buying a home. The mistake is buying without planning for everything that comes after the purchase. Affordability today is not just about qualifying for a loan. It's about whether you can sustain ownership for 10, 20, or 30 years. Because in the modern US housing market, stability doesn't come from ownership alone. It comes from understanding the full cost before it understands you.